Hello, and welcome back to Explain the Charts, your channel for no-nonsense technical analysis. Today is November 17th, 2025, and we're taking a deep dive into the SPDR S&P 500 ETF, ticker symbol SPY. We've seen some major volatility recently, so we'll break down the latest news and then hit the charts to see what the price action is telling us. First, let's cover the headlines because the macroeconomic environment is crucial context for what we're seeing. Reports from late last week highlighted the worst market session in over a month, with the Dow, Nasdaq, and S&P 500 all taking a significant hit. Much of this downturn was reportedly fueled by investors pulling back on bets for interest rate cuts. The tech sector in particular, which has been a market leader, showed signs of weakness, with names like Nvidia being hit hard. This has amplified chatter about a potential AI bubble that might be slowly losing air. Adding to the caution, we've heard warnings from prominent figures like Jamie Dimon about potential cockroaches in the credit system, pointing to brewing trouble in household and corporate debt. This negative sentiment creates a very tangible headwind for the market. However, it's not all doom and gloom, as we also saw news that Berkshire Hathaway took a position in Google's parent company, Alphabet, showing that some major players still see value. Now, let's see how this nervous sentiment translates to the price action on our charts. Looking at the daily chart for SPY, we can see the broader story of the last year and a half. After a massive run-up from a severe drop in early April, the market established a strong and consistent uptrend. This trend carried us from the low 500s all the way to new all-time highs in late October, just a few weeks ago. The peak was established right around the $689 mark, which now acts as our primary, major resistance level. Any bullish continuation would need to decisively break through this ceiling. However, the last few weeks have painted a much different picture. We saw a sharp rejection from those highs, culminating in the dramatic sell-off last week that the news was reporting. That brings us to our key support levels. The first important area to watch is the low from last week's plunge, right around $663. This is the market's current line in the sand. Now, let's zoom in on the action since October to get a clearer view of this reversal. As you can see, the ascent to the 689 peak was followed by a few days of consolidation, which can often precede a reversal. The breakdown started in early November, but truly accelerated on November 13th with that massive red candle, which represents that worst session in a month we talked about. That single day erased weeks of gains and signaled a significant shift in market character. The subsequent candle on November 14th shows a bounce off the lows, but it closed well below its open, indicating that sellers are still very much in control. This price action is a textbook example of a failed rally attempt, reinforcing the bearish momentum. Switching over to the 1-hour chart, we can dissect last week's trading action more closely. Here we can see the relentless selling pressure throughout the day on November 13th. There were very few meaningful bounces as each hourly candle made a lower low. The price fell from around 683 all the way down to below 671. On November 14th, we saw an initial gap down followed by a rally attempt. However, that rally failed to reclaim the key 676 level and ultimately sold off into the close. This intraday action tells us that while some buyers are stepping in at these lower prices, the selling pressure is still overwhelming them. The 676 to 680 zone has now flipped from support to a key short-term resistance area. Now for the shortest time frame, the 15-minute chart, which gives us a granular view of the battle between buyers and sellers. Looking at the end of the day on November 13th and all of the 14th, the action is extremely choppy. We see sharp drops followed by weak, unconvincing bounces. The market tried to build a base around the 672 level on the 14th, but ultimately couldn't hold it. The volume on the down moves appears stronger than the volume on the up moves, which is a bearish indicator. For day traders, breaking below the 671 level would be a key signal for further short-term downside. Conversely, reclaiming and holding above 675 would be the first sign that bulls are starting to regain some footing. So, let's go back to the daily chart and put it all together. The long-term uptrend has been broken, and the short-term trend is decisively down. The bearish case is strong right now. With negative news headlines and a clear technical breakdown from all-time highs, the path of least resistance appears to be lower. If we lose the immediate support around 670, the next logical target for bears would be the swing low from October 10th, down around 653. A break of that level would confirm a more serious correction is underway. What's the bullish case? For bulls, you'd want to see the market firmly hold support at last week's low of 663. If the price can consolidate here and build a base, it could be seen as a healthy pullback. The first major hurdle for bulls is to reclaim the 680 level. A strong move back above 680 would begin to trap short sellers and could fuel a rally back toward the highs at 689. However, given the current momentum, this seems like the less probable scenario in the immediate short term. To recap, the key levels are critical right now. Keep your eyes on major resistance at the all-time high of 689 and the more immediate resistance zone of 676 to 680. On the downside, immediate support is at the recent low of 663. If that fails, the next major support level to watch is 653. Given the technical breakdown and negative sentiment, I would assign a roughly 65% probability that we retest or break the 663 support level in the coming days. Conversely, there's about a 35% chance that this level holds and we see a relief rally back towards 680. A decisive break in either direction will likely determine the market's trend for the remainder of the year. Look for follow-through selling or a strong, high-volume reversal to confirm the next move. That's our analysis for today on Explain the Charts. Thank you for watching, and remember to like and subscribe for more in-depth chart breakdowns. Finally, a quick disclaimer. This video is for informational and educational purposes only. It is not financial advice, and you should always conduct your own research and consult with a professional before making any investment decisions. Trade smart, and we'll see you in the next video.